Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today, we're going to be analyzing CACI International stock. The stock is currently down about 30% off its highs, and it's done that. It's fallen that much in the past, call it 2 or 3 months, basically since the U.S. election. As always, this is not individual investing advice. This is just how I analyze stocks. So this came in by request down in the comments section of one of my other videos, but I have owned this one in the full Cyclical Investors Club for a couple years now. Let me see when we bought it. September 27th, 2021. I'm going to guess during this dip maybe. That's 2022. Right about here. So historically, they've grown earnings, at least back at this point. They had been growing earnings about 13% a year, which is very good. And at that time, the stock was trading at about a 14 PE, so the valuation looked good. Basically, a solid growth stock at a pretty cheap price. And we're up about 50% on that position, even after this 30% decline off the top. So I am long this stock, and I'm going to share a buy price for it and talk about some of the potential risks. It is pretty interesting. I think let's go ahead and shrink this down to like the past 10 years or so we can get a feeling for earnings growth. Let's also move this in a little bit here. So earnings growth wise, not including buybacks and a couple of these down years, earnings have been growing about 16% over the past decade. Analysts are expecting 11% growth the next couple years, which is lower. I'm going to use the more conservative earnings growth estimate of 11% for this analysis, just to kind of be on the safe side here. Now, even though the stock is down it's over 30% now. I'm not sure how much, if it's down today or not, but probably approaching more like 35% off the highs. That high was kind of a weird spike. And basically it started at the beginning of 2024 and ran right up until the election. I don't know if this was like some sort of an election bet or whatever. I mean, we've seen these happen before. Going into COVID, they traded at like a 23 PE. The peak here was like a 25.5. So not totally unprecedented. Let's see if we have any more spikes like that. We had one here, kind of up to 20 PE, and then way back in 2005, kind of that range too. So it's not a totally unprecedented move, but we want to be careful about just saying, okay, the stock's down a lot, it has a good track record, let's buy it. All right, we really want to do the math on this because it probably wasn't completely justified being. I mean, in some ways it was, because the rest of the market was overvalued too. But just because it's fallen this much doesn't mean it's cheap, is basically what I'm trying to say. Now, so what these guys do, I think when I originally bought these, I didn't even really quite know what they did. I bought it mostly based on metrics, but this is from ChatGPT. So, U.S.-based company that provides IT solutions and professional services for government agencies, primarily in defense, intelligence, national security. So I looked it up. It looks like about 75% of this is from defense, and then the other 25% are from other areas of the government. And then you can see cybersecurity, IT solutions, software engineering, logistics engineering, surveillance and reconnaissance. I haven't said that word in a long time. So the question is, so we have the Doge committee that's going in. From what I'm seeing on the internet, they're being pretty aggressive, collecting data and, trying to get rid of people and hold departments, it sounds like. So that risk, I think, is what has triggered the current sell-off in the stock, okay? Now, how to quantify that risk is a little more difficult. On one hand, 75% of their money is coming from the Defense Department, and I don't know how aggressive they're going to be with Defense Department cuts and exactly what kind of structure that's going to take. So I think that there's risk here, but it might not. I mean, it doesn't seem like this is the particular area that's being targeted right now in terms of government efficiency cuts. We don't have a ton of information. What I've seen is it's less defense, more. Well, we've seen what international aid. We've seen some consumer protection probably areas where changes are being made, and some I didn't make a list of them, and they keep popping up. But Elon's kind of going through everything and collecting the data and trying to push people out. But I don't know if he's going to do that for what these guys do. It's possible some of their stuff. I mean, 25% is coming from outside the defense, so I would expect probably some cuts are going to eventually get made somehow. But it's hard to quantify that, and it's basically down to like a 16, which relative to the market is pretty cheap, honestly. I mean, their earnings are still, we're going to expect them to grow 11% the next couple of years so far. And so there's risk. It's really hard to know the downside risk, I would say. But we know that they have a good track record overall on the upside. So to me, there's kind of a cautious, it would be like a cautious buy if a person came in to buy it. And we want to buy it at a good price with some maybe slightly additional margin of safety. So what I'm going to look at is the time until payback analysis. So what this does is it takes that 11% earnings growth, which I have right here, it projects that out into the future, and it tries to see how long it would take the company to pay back an investor, however much they invest into it, via just their earnings, okay, and earnings growth. So if you invest $100, how long would it take for your share of earnings to equal $100 if you collected those earnings over time? So we start doing that calculation by getting an earnings yield. So this is the earnings yield right now. Oh, one other thing worth mentioning. I almost forgot this because I worked on this last night to get it ready for today, and then I forgot. They do have like a significant amount of debt, and their credit rating is only BB+. This can add to like potential volatility during downturns or times of stress, right? I account for this in my valuation price. So I'll go see how much I added to the stock price. So I make that adjustment here. I added 38% to the stock price. So if you were just doing like a PE thing, one of the reasons the PE is like a 16 is because that doesn't include, I use the difference between the market cap and the total enterprise value to calculate the additional. Basically, I use the total enterprise value instead of the stock price to calculate the debt adjusted PE. But the long-term debt they're saying is 47% of the cap. So that's pretty much in line, right, with the adjustment I'm making of 38%. So the way to think about this, if you're just using the PE, which is the price over the earnings, is that assume the price is 38% higher than it really is when you're going to buy the stock, right? So that means the PE would be 38% higher as well. So about 1/3 of, 16.69, we'll call it, what would that be, like 22, 20, probably like a 23 PE. So when you look at it that way, the PE is pretty close to in line with the S&P 500. It's not nearly as cheap, especially the bigger tech companies, right? It's not nearly as cheap as it appears. So that might be one thing to consider that probably just a normal person who's just glancing at this and not looking at it a little bit deeper might not pick up on. So it's really not super cheap yet relative to the rest of the index. It is a little bit cheaper because their growth is better. If they can grow 11%, which historically they've grown over 13, if they can grow earnings at 11%, then that's a lot faster than the average S&P 500 stock. Even most of the big, Apple's not even growing, like Tesla's shrinking. A lot of these big companies, other than like Nvidia, aren't growing that fast, right? They aren't growing earnings super duper fast. So 11% growth rate is better, even if the initial PE is similar to the S&P 500 average. All right, so that gets us in here. So I'm treating this as if the stock price is $539. And when I do that, the earnings yield, which is the earnings over the price, it's the same thing as a PE ratio. I might have the PE ratio here too. Let me see. No, that's earnings per share. So I'm using, in order to calculate this, the forward earnings per share, $24.40, which looks like it's 2 quarters ahead maybe. And the current price, debt adjusted. 4.53%. So if you invest $100, you'll earn $4.53 back in earnings the first year, and that will grow at 11% per year. So if we want to see what that looks like here, so the first year with growth, you'd earn $5.02 on your $100 investment. And then that would grow at 11% each year, and you would collect that money each year. And how long would it take you to earn an additional $100 or turn your 100 into 200, which is how it's expressed here? And it would take about 12 years. Now, given we have some uncertainty here, I probably, if I didn't already own it, I would probably look to buy this at a 10-year time until payback, which the conservative edge of that, where it's kind of in between 9 and 10 or just barely 10, is about $278. I have another method that I use to do this kind of valuation that's a little more precise, and it's leaning more toward the conservative end. So this is also more, I went ahead and moved this toward the more conservative end. So I think if the stock price got down to $278 per share, then it would be worth a buy, assuming nothing really major has changed. Something could change between now and then. Maybe their guidance is for earnings declines or something like that. That would be reason to reevaluate and maybe wait for a bottom before potentially buying. But as things stand right now, I think that's a reasonable spot to at least add half a position, and then maybe, since it's falling straight down, wait until momentum's better before considering building that to full position. That's probably how I would go about it, even though I'm long the stock already. I think this is one in the current time you want to be a little bit careful, but you don't want to panic too soon and refuse to kind of buy on the way down, because if a good news item comes out along, or the stock could jump 20% quickly if it looks like maybe they won't be super affected by things. So you don't want to completely miss the deal, but you have to acknowledge the risks that are there. Okay, let's see. I think that's all. If anybody else has a request, put it down in the comments section. I'll get the ticker on the board and I will make a video for you. I have a $25 a month tier level over on Patreon where I share a stock pick each week. Those are doing really well. I think we're doing about 3 times better than the S&P 500. I just launched that last October. And I also have a free tier on Patreon where I post all these same videos if you're interested there. So definitely check out those Patreon links, and I will see everybody later.